Good evening, everybody, and welcome to Le Fond International. Happy New Year. I'm Alexandra Georgiev, and we're going to be together for the following 1 hour and a half. And as you can see, great beginning for the year for the U.S. indices, great beginning of the year for the U.S. indices. Actually, U.S. stocks are hitting fresh record highs. Once again, S&P 500 is 0.4% higher, Dow as well 0.7% higher, and Nasdaq Composite 0.7% higher, trading once again above the 9,000 level, more precisely 9,034 points so far. The VIX index slightly lower at the 12th level, and all the FANGs and of course industrials are leading the gains so far on the U.S. markets. But I want to switch very quickly to the fixed income. The U.S. 10-year is yielding 1.88, the tier 1.58, and the 3-month 1.54 so far. It's been great trading session also for the European indices. I shall say that Stoxx 600 closed higher by 1%, and of course once again great performance for the bank and technology and the technological stocks. If we have a look at the single European bourses, all of them closing the deeply green territory. The German DAX 1.03, the CAC around 1.06, FTSE MIB 1.40, and FTSE 100 0.8% higher. I shall also point out that there have been several stocks on the move. I want to show you in particular Airbus. Here it is 2.33 in the green, but I shall point out that Airbus has become the world's largest airplane manufacturing for the first time since 2011, ousting Boeing from the top spot after beating forecasts on its 863 aircraft in 2019. Reuters reported yesterday, citing airport and tracking sources, Airbus shares gained more than 2%, as we can see 2.33. On the other side, best performance in terms of single stocks were the German banks, in particular Commerzbank 6.85% higher, and of course Deutsche Bank 6.22% higher today. Great beginning for 2020 regarding, of course, the banking sector. We're going to discuss this on the show a little bit later. I want to first give you some stats actually regarding the markets, and I want to start exactly with the US markets, how they closed 2019. The Dow was up 22.3%, S&P 500 28.8%, which is almost 30% higher, and Nasdaq up 35.2%. Great numbers over there, but we're going to analyze the single performance of each and every one of the indices. On the other side, I also want to point out that it's not surprising that we have this great 2019 for the US indices, but it's been so also for the European stocks, in particular Stoxx 600 closed 23% higher. Actually, that's the biggest gain since 2009 for the pan-European index, and not only the Shanghai Composite climbed 22% despite the US-China trade clashes during the year. And we're going to analyze, as I promised earlier on the show, each and every one of the indices. I want to go now to one of the major stories nowadays, and it's regarding, of course, Carlos Ghosn. Actually, ousted Nissan boss Carlos Ghosn decided to flee Japan after learning that his trial had been delayed until April 2021, and also because he had not been allowed to speak to his wife. Ghosn, one of the world's best-known executives, has become Japan's most famous fugitive after he revealed on Tuesday he had fled to Lebanon to escape what he called a rigged justice system. Japanese public broadcaster NHK said Japanese authorities allowed Ghosn to carry a spare French passport in a locked case while out on bail. On the other side, authorities have not officially commented on Ghosn's disappearance. Government offices are shut this week for the New Year holiday. But I want to bring you the latest regarding the case. Actually, Lebanon received an Interpol arrest warrant today for former Nissan boss Carlos Ghosn, while Turkey launched an investigation into his daring escape from Japan via Istanbul. Actually, Carlos Ghosn has become an international fugitive, of course, after what happened. Sources close to Ghosn said a delay to a trial and a strict ban on communicating with his wife motivated him to go ahead with a plan to use a private security company to smuggle him out of Japan via private jet. And what is really important to point out is that he actually released a message to the press only a few hours ago saying that he was the only one who planned this and did it by himself, and his family, wife and 2 kids were not involved in the fleet planning. So that's certainly a very interesting story. We're also going to have a look at the single stocks, how they have reacted so far, because the Nissan-Renault alliance had a very difficult year, very difficult 2019. It's very curious what is going to bring 2020 for the two major automotive companies. But before we go ahead, in order to delve deeper into this story, let me bring to the show my first guest this evening, John Irgas, Chief Economist, Tigris Financial Partners. Good evening, John, and thank you so much for joining us.
Good evening. Thank you for having me. Always a great pleasure. Always a very great honor. Thank you, and Happy New Year to you and to all the listeners.
Happy
Thank you.
New Year,
This is a very
John.
good year.
Hopefully.
A very good year for all of us. Hopefully, yes.
Hopefully. I want to start with this major story. First of all, I mean, it's very surprising that someone manages to escape Japan, because Japan is very strict country, lots of controls over there. First of all, what is your interpretation of this story? And then we're going to move to the stocks.
Look, I think the situation is extremely simple, is that there was a very complex situation. I shall certainly not opine on the guilt or innocence of anybody, because I believe everybody deserves a fair trial and due process. But I think this is really a political story, which is what we're seeing play out here. This is not even a judicial story. This is a clash between two different styles of management. This is an attempt to turn around an alliance. This is an attempt to thwart, let us put it this way, nationalism possibly on both sides, and that in the end it is people who are caught up in these situations. Now, I think that, you look at the case of Ghosn. He is now in Lebanon, and I think the really interesting thing for us is whether this will set an international precedent for legitimacy to this type of action. If an executive of a foreign company or of a company is in a foreign country, which he is not, he are not nationals, are they legitimized to leave if they believe that the system is not fair? I think it's a very important point. Quite frankly, I think this transcends the specific issue of Ghosn, Nissan, Renault, the car industry, or whatever. It's really a question of principle here. So I think we're going to have to be seeing how this develops. I believe that it will intensify on that front. I believe that there is this Interpol red alert. This is very serious. They do not do this lightly. From what I understand, Lebanon is not required to arrest. They've received this request. So let's see what happens now. I think my bottom dollar bet is that at some point we're going to be seeing more, that it's not interference, but more articulate taking of a stance by the French government, because the French Renault company is the business partner. There's absolutely no way you can transcend the business alliance, which was at the root of this whole story. So I think that's going to be extremely interesting. But the real point is the legitimacy. Is anybody entitled to get up and say, I don't like how the courts are run in this country, right or wrong? I do not feel I shall have the right to fair trial.
Well, we have some problems with the line so far, because we don't hear John Irgas, but we're going to try to reestablish. On the other side, I want to show you very quickly Renault and Nissan. Both stocks closed lower this evening. Renault in particular is a little bit more than 0.6% lower, and Nissan on the other side 0.5% lower. Certainly, it's been a very, very difficult year for this alliance, as just my guest pointed out. And on the other side, it's probably going to be a very difficult year also, 2020 for this alliance. And of course, Carlos Ghosn had a lot to do, because as soon as he was removed from, of course, the helm of the company, of this alliance between the two major companies, there was a major problem. It looks like we have back on the line John Irgas. John, are you there?
Yes, I'm actually here on the phone. You can also call me on Skype.
All right, go ahead.
Okay, so I think basic situation is this. So you really have a situation which is extremely complex. You have a situation which is political. You have a situation which is economic. And we also need to look at the situation from a point of view of the separate companies. And we have to see that the stock performance has not been good of any of the three of the alliance, because remember there's Mitsubishi there as well. And that Nissan stock, I'm reading, is trading at less than 0.5% of 50% of book value, which is not a great recommendation. So the question becomes this. The question is, there was originally a big program, and this program was based on cost cutting, okay? And this cost cutting was very effective. Now the car industry is facing new challenges since this first program was launched under Ghosn, who was known as the cost killer. This was his reputation. So what are they going to do next? And my gut feeling is that this idea of cooperation between companies is not sufficient. This is a business which is built on full integration and economies of scale, and we may start seeing mergers emerge here. I think this is nothing more in many ways than the buildup on the industrial front of the full merging of more car companies to be able to compete and be able to generate the cash flow necessary to meet the structural challenges of the industry. I think this is what it's really about.
On the other side, it's been quite a difficult year for the two stocks, both Nissan and Renault.
Sure.
Very difficult alliance, many, how can I say, many difficult days actually, and this alliance have been questioned, and because of this alliance, we didn't see actually merger between FCA and Renault. So what do you think is going to happen in 2020 in terms of the stock performance, because they had major decline for the year, also in terms of production?
Look, I think it's a production issue. It's not just a valuation issue. It is a critical issue of the whole industry. I think that the car industry as a whole will have to go through an extensive process of restructuring, and it will not be easy. We're looking at years and years here. We're looking at reforms which were not put through. We're looking at half measures which were not sufficient. And now this will take some time for it to actually sort of gel, as they say. I think this is going to be a very tough haul here. Very tough haul, and that these are restructuring stories that we're looking at. They are not growth stories. Before they can grow, they must restructure. They cannot grow out of the current predicament and the current structure in which they are, and this is going to require vast amounts of free cash flow, which they do not have. And I was reading reports that Nissan will not have free cash flow again, I think, until, or even net operating cash flow, if I'm not mistaken, very poor cash flow position until at least another year. So there it is. Plus financing requirement, plus restructuring requirement, plus transcending or resolving political differences. And of course, now the big decision is going to be, what do you do about the alliance? Can the alliance withstand the pressures arising from this, let us put it this way, episode? This is the real issue.
Well, certainly we're going to talk about this topic as soon as we have more details. I want to get back now to the US indices, because we do see major kickstart of the year. It's incredible. Sure. I mean, this crazy rally continues in 2020. It looks like it's going to be even more positive here. I just wanted to bring you some stats. For instance, Dow closed up 22% higher for the year, S&P 500 almost 30%, and Nasdaq up 35.2%. On the other side, the Stoxx 600 finished the year up 23%, its biggest gain since 2009, and the Shanghai Composite climbed 22%. Jean, I want to hear your comment on these figures and how different it is. This, how can I say, 22.3% higher for the Dow, and on the other side, 28.8% higher for S&P 500.
Well, I think you're also going to have to be looking at what the weighting of the Dow is. The Dow is fewer stocks. So if there's a couple of big stocks that have taken a big hit, for example, during the year, you will see the impacts much more. It's really that simple. I mean, I don't want to name them, but there's a big aircraft company which has had some problems. So obviously that, and they are in there, and that is going to pull down the index. If another company has problems, it's going to pull down the index. The S&P 500 is a much broader range of stocks, and therefore each stock will have a lower impact. So I think this is basically how you have to look at it. I think that obviously investors are still pouring liquidity into the market. There is still this liquidity surge. I believe a lot of it is possibly non-directional, which is simply asset reallocation or asset allocation strategies, both, let's say, between different asset classes, such as bonds and fixed income, and within each asset class of stocks. So I think this is very important to understand. It's not just that the markets are going up, it's that the market's actual purchases are actually changing, and people are rotating from one sector to the next as they start believing that the recession risk, nobody can eliminate it, but maybe is less than before, and therefore they're more willing to take certain risks. I think this is what is going on here. I also think that when we look at the famous 28, 23%, we must remember that we were starting the year having hit a bear market, and then we had a bounce. So we have to look what the reference point was. Where did we start from? We started from a point which was substantially lower than where we had been during the year 2018. So these must be taken into account. But nonetheless, I think there's a fair amount of optimism out there that possibly the worst has been averted, and that possibly we will come to an agreement with China. I don't know how much of an impact this is going to have, but it'll be good for morale, according to some, and optics. And that some are seeing green shoots in other regions, potentially seen as a slowing of contraction. So I think this is basically it for the time being. I think there's a lot of event risk out there. Anything could happen with still the US-China. We have not seen the definite agreements. We do not know their enforceability. And let us remember, there's been a lot of false starts on the European front as well.
On the other side, do you think this 22% higher for Stoxx 600 is something significant, something positive, considering the economic situation here in Europe?
I think it is. I think it's obviously got to be seen positively because, I mean, let's put it quite simply. I mean, what was going on in Europe was that there was a great amount of hesitation due to systemic risk. Okay, people said, well, I'm not just looking at Europe from a cyclical point of view. I'm looking at Europe from a point of view of an area where the currency was at one point under existential threat, and where there's still a banking system which is fairly weak, which has to contend with things such as the Brexit, the rise of populism. And now people are saying, well, you know, maybe it's not so bad. Maybe they'll pull through. So we're reducing basically the political and systemic risk discount. And this is what we are seeing. The economic picture as such, let's say in traditional terms, is not optimal at all. Nobody's saying this. We're going to be seeing a maximum maybe of 1%, 1.2% if we're lucky, on the Eurozone, which in the US would be considered a recession and which is de facto recession, 1% margin of error. But still, people feel the bottom will not fall out of it. And I think this is what we're seeing in the readjustment of stock prices. We're also seeing a realization by some that a lot of these companies are being beaten up due to sovereign risk, but in fact have a large part of their cash flows. For example, 40% of the turnover of the CAC 40 is in the United States. So therefore, if the US does well, automatically you start having these multiplier repercussion pass-through effects to specific sectors of the European stock market, which in fact are European in name only and derive a substantial amount of their revenue and cash flow from economies which are doing, let's not say brilliantly, but which are doing respectably. So this is very important. The distinction between the equity market and, let's put it this way, the basic economics is absolutely critical to understand. Who is doing well here relatively?
Right.
Some of the big companies, not the SMEs. This is the point.
Absolutely, I agree with you. On the other side, you just said something very important. You said that according to investors, recession fears are fading away, so they are more willing to risk and, of course, invest in equities. On the other side, I wanted to show you a very interesting article of the Wall Street Journal that says recession fears rise for CEOs as trade concerns linger. I also want to remind our viewers that actually President Trump announced in a tweet on Tuesday that a partial accord will be signed at the White House by senior Chinese negotiators in 2 weeks' time. But still details are lacking. So this is a little bit of a concern, no doubt about it. So personally, if you have a look at the bond market, do you think recession fears are fading away, or we still have to be concerned?
Well, I think we always have to be concerned because there's no details on the story of China. I mean, I still don't know what they've agreed, if they've agreed anything. I am still of the view that this is much more a letter of intent than a firm commitment on either parts. This is, we shall see what we shall do. We'll see what we can do. Yes, if there's a problem, it's procedural. It is not normative, as we have often explained. So I think, don't get your hopes up on that one. It could be much less than we have expected. The bond market plays the long game. The bond market plays the long game. The bond market does not play 90-day earnings. The bond market looks out years, and the bond market is sending a message which is roughly as follows. Growth will be slow, and basically, do not expect either high inflation or high growth rates for the years to come. So basically, what this leaves us with is increased dependence or continued dependence on export markets and the hope that central banks will continue to play the monetary policy game. This is what's really holding the whole thing up. I mean, if you have, for example, the US-China agreement in terms of soccer, and this is the big striker, the center forward, we have the central banks who are the goalkeeper. But the central banks will not always, the goalkeeper does not always succeed in catching the ball. So it's that simple. We have a goalkeeper, but the enemy team can advance. And we can also not score. So this is basically what's going on. So I think it's not a simple situation, but people think, well, look, maybe the worst is over. We can live with slow growth, managed slow growth, but we don't want to have a systemic event, which nobody can exclude, but I think most probably at this point is a bit less than before.
And talking about central banks, what is your comment on the fact that the People's Bank of China actually on New Year's Day lowered the amount of reserves banks need to keep on hold at a central bank? How do you explain that?
I explain it very simply is that, quite frankly, I mean, the Chinese economy, yes, it is growing. It is not growing maybe at the great rates that it was growing before, but it is growing. And the second point, which I think is more important, is that the Chinese government has decided two things. First, that the economy, yes, is now no longer this export-dependent machine, but a large part of their economic growth must come internally. Two, to actually drive this economic growth internally, these companies which are being favored are the SMEs, and they have lesser access to credit in traditional markets or in traditional times, and therefore you must give them money, and they also have lesser cash flow to self-finance. And three, this might be the lesser of two evils, because it's true that you increase lending to potentially risky firms. On the other hand, it is the banks that do this and not the shadow banking system. Remember, the shadow banking system in China works parallel to the banks, but is slightly regulated, difficulties of regulation, and many of them have gotten into trouble. So the government can achieve two aims by this method. You can, on the one hand, provide financing to the SMEs, which are the internal generator of jobs and also of domestic growth. And at the same time, it can reduce the weighting of the shadow banking system and reducing the systemic risk which arises from a lightly or difficultly regulated and not controlled system of financing within the country. So this is very important. I do not believe that this will have big repercussions abroad. The types of companies these are going to are not the huge export machines. On the other hand, it will basically stave off short-term, mind you, a further contraction or slowing of growth, to be exact, in China.
Well, certainly China suffered the most from these trade clashes with the United States, but I want to bring you a very interesting story, but this time regarding China and also London or the United Kingdom, but London in specifically. China has temporarily blocked planned cross-border listings between the Shanghai and London stock exchanges because of political tensions with Britain. Suspending the Shanghai-London Stock Connect scheme casts a shadow over the future of a project meant to build ties between Britain and China, help Chinese firms expand their investor base and give mainland investors access to UK-listed companies. Certainly, many people's comments were because this is, of course, political question because of the Hong Kong protests. They were very, very severe also during the New Year's Eve and the New Year's Eve celebration. So what is your comment on this story? And is it something that actually is going to damage China, in your opinion?
Look, I think China has to do something to react to the critiques. I mean, simply because of sort of projecting itself also in terms of its own citizenry. I believe that they will talk, but they will not act enormously. Nobody is out to boycott China or to stop selling to China. And I have to be extremely clear what we're talking about. These are not sanctions. These are measures one-off. So I think they're doing the minimum they can, so to speak, to assuage public opinion. I think the message China is sending to the world is now different. Before, the message China was saying to the world is we are a strong economy based on exports of manufactured goods, and this is what we do. Now they've shifted from being an exporter of the manufactured good to being a provider of capital and an exporter of capital. And they're starting to run into difficulties. We have seen the discussions with the EU. If you remember, we discussed this as to the extent to which the Chinese companies could actually invest in certain sectors in the EU. So I think that basically this is part of the growing pains of the Chinese story, from an exporter of manufactured goods, let's say low value added, to actually having generated sufficient capital and wishing to deploy it abroad for either strategic or financial purposes. One way they can react, and the others are also very interested now in China as a provider of capital and of liquidity in markets. This is very, very important. So I think that this is one way to retaliate. I do not believe that this is going to bring down any sort of cooperation between China and the rest of the world. Remember, this is not a sanctions situation we're looking at here.
All right. Thank you very much. John Ergas, Chief Economist, Tigris Financial Partners. Thank you very much for joining us, and have a happy new year once again.
Thank you very much. Thank you very much, Alice. Goodbye. Cheers.
Well, we're heading for a very short commercial break, but stick around, guys, because in the next part of the show, we're going to do chart analysis, and not only, we're going to focus on the European banking sector and the energy sector. Welcome back to Lefort International. This is our second part of the show, and actually I shall say welcome to chart analysis. I want to show you very quickly the US indices, actually major kickstart of the year. S&P 500 0.3% higher, 3,240 points. Dow as well hitting new all-time record high, 0.6% higher, and Nasdaq Composite getting back, of course, trading above the 9,000 level, 9,041 points. This is incredible, almost 0.8% higher after the record highs in 2019. It's been so far great beginning of 2020, and I shall say something that it was the same story for Europe. We saw Stoxx 600 closing higher by more than 1% and actually closing 23% higher for 2019. Great performance of the major averages so far. I want to show you also very quickly the bond market. So far the US 10-year is trading 1.88, is yielding 1.88, the 2-year is 1.58, and the 3-month 1.54. In terms of European bonds, the German Bund 10-year is minus 0.22, the Italian 10-year is 1.41, and the spread between the BTP and the Bund is 163 basis points so far. Very quick look also at the dollar index, snapping 6-day losing streak, 96.87 so far, almost 0.5% higher this evening. Euro dollar 1.11, still very high levels, but 0.4% lower, and the sterling against the dollar 1.31, as we can see, almost 1% lower. This evening, certainly we're going to discuss each and every one of them, but I want to talk about a major technological stock, and it's Apple, because we have some updates over there regarding the Apple strategies. Actually, Apple will start working again with British chip designer Imagination Technologies, years after dissolving its relationship with the company. In a short statement, Imagination Technologies announced a new multi-year license agreement under which Apple has access to a wider range of Imagination's intellectual property in exchange for license fees. The semiconductor company previously designed GPUs, which are graphics chips, for Apple's iPhones and iPads, but Apple decided to cut ties with a firm in 2017 to develop such processing units in-house. Whether this move was ultimately successful remains so far unclear. That news sent the once listed firm shares tumbling as much as 71% due to concerns it would heavily impact its future. And of course, it had a major impact on it, that's for sure. A very interesting decision for Apple. We are certainly going to follow the developments. I want to remind everyone that talking about Apple, the stock closed 80% higher for the year, and this is a complete record. Together with Microsoft, they were the two best performing stocks in 2019, and it's not surprising at all, that's for sure. Anyway, before we go ahead, let me bring to the show my next guest this evening, Daniel Gramza, President Gramza Capital Management. Good evening, Dan, and Happy New Year.
Well, good evening to you, and Happy New Year to you as well.
Dan, we've been talking a lot with you for the US indices, but I shall say they had a great 2019. What's in store for 2020 in your opinion?
I'm looking for more of the same. Our economy still is stable. We have an accommodative Federal Reserve. Our unemployment's low. Consumer confidence is high. And consumer spending is still on track. So we have the right elements together, I think, to create that momentum. And we're seeing things that imply that the momentum can continue. I mean, we have the China tariff situation that may be resolved on January 15th with the signing of phase 1. We see in China, their central bank being accommodative as well by lowering the reserve requirement by 50 basis points. And that adds about $115 billion of equity or liquidity to that marketplace. So I think globally right now things seem to be status quo, and I look for follow through to the upside.
And regarding this China-US trade deal, President Trump tweeted on Tuesday that an accord is going to be signed in few days, I believe, but still we're lacking many details. Do you personally think that traders are a little bit too optimistic so far? Because, U.S. stocks are overbought. No doubts about it.
Well, I think that they're optimistic and that something's going to be done. That's the issue. And we're finally hearing China saying they're ready to do something, and the US is saying they're ready to do something. So the fact that they're going to sit down and agree to something is a step in the right direction. And I think people are optimistic about that. The details of this, I'm sure not everything's going to be solved, and they have also said that this is a phase one, but it's a step in the right direction. And I think that's what the market's been anticipating. And that's also one of the reasons why we're seeing this movement to the upside, is that optimistic attitude towards the market.
And are you personally optimistic also for the markets? Because, for instance, S&P 500 closed 28.8% higher for 2019. What kind of figures can we imagine for 2020?
Well, I wouldn't be surprised to see something over 20% if this year maintains its momentum. I think we have that possibility. And we also have things coming up. We have to see what's going to be happening with Brexit. We have a U.S. election that's going to be interesting to see how the market sets up for that. So we have some things out there that it's going to make this year, I think, very interesting. But I'm looking forward to it. I am on the optimistic side for the stock market.
On the other side, I wanted to point out that as we were talking during the commercial break, it's been a great year also for European equities. In particular, Stoxx 600 closed the year higher by 23%. And this is great, I shall say, considering what is going on here in Europe in terms of macroeconomic data and single performance of the single countries, because you know situation is particular here in Europe. It's not the most, how can I say, united situation between the single countries so far. We also lack a lot regarding fiscal policy, and it's very difficult to implement fiscal policy for each and every one of the single European countries. So are you interested in European stocks? Because if we compare Europe Stoxx 600 and S&P 500, there is very, very tight difference in the performance, considering the fact that in terms of economic performance, the two countries have very different track record for 2019.
Well, they do. And you're right, you've identified some challenges that the Eurozone and the European Union need to solve. But I also think they will. As the economy grows, not only, well, the United States is the largest economy. So what happens here does have a bleed over effect to other countries. But my feeling is that if we maintain this momentum, that, a rising tide raises all the boats. And I feel that Europe will get things straightened out that it needs. Germany is such an interesting bellwether of what we can expect. And, we have kind of mixed signals, I think, when I look at Germany. You figure Germany, France, Italy, and Spain, the four largest countries economically, from an economy point of view, represent over 70% of the European Union GDP. Or Eurozone GDP, I should say. So it is significant what happens there, and they are the bellwethers. But something that's interesting to me. Now, as you and I were talking before we started today, I do a daily video at dangramza.com, and what I was saying there for today was the key would be Asia. Asia sometimes sets the tone. Now, I didn't know the central bank was going to do something, but when it starts out that strong, we oftentimes see that follow through in Europe and in the US. And that's what I was looking for today, and it's what I'm looking for tomorrow. There are other times I believe that the European time zone sets the tone, becomes the critical barometer for me in terms of the US session. I'm looking at futures, which trade almost 24 hours a day. So 5 o'clock yesterday, Chicago time, midnight your time, is when Asia opens. So for me, I go to sleep looking at Asia, and I wake up looking at Europe. to see what kind of behavior that we're seeing collectively in those economies. So right now, I think we're going to finish this week out with some positive action. Even if we do not make new highs tomorrow, it's still a reflection of the attitude people have with the start of this new year.
You know what's very interesting? The Shanghai Composite added 22% for 2019. Do you think this is a sufficient percentage considering the trade spat between the US and China, and considering the fact that China in general is less open to foreign investors?
You're absolutely correct there. And what's interesting is that we're seeing a change in attitude in China. You're right, they're not keen on outside investors coming into their economy. But you know something? That makes sense. When you look at the capital formation of a country, it typically starts with stocks, then it moves to bonds, then it'll move to futures, may move to options, those type of products as they're developed. There's a few things that a country will do. Now, what I'm going to say to you are my observations if we think about Turkey and Korea and Thailand, other countries as well, as they've developed their capital market system. The issue here is this. A country at the beginning, what do they say? They say no outside investment, and they say if you are a Chinese, you're going to invest in our country. South Africa is another example of this when they started. So they said, okay, you can only invest inside of the country, and we do not want outside investments. As the capital market system matures, they now have confidence to allow outside investments. And here's where we're seeing a change in China, and it's in the futures market. China is opening its doors for outside investments in the futures area. So I think that's an area of growth that we're going to see for this coming year. So I think we should watch that. China, as far as the Shanghai Composite goes, that growth really kind of surprises me, to be honest with you, because there are many challenges within China that they're trying to sort out from the economy point of view. To the change in the basis points for the central bank for reserve requirements is an example of that. But I think it's a step in the right direction. They need to have some kind of an agreement with the United States. And we always want to remember that what they do with the United States is also probably what other countries are going to ask for as well. So other countries are watching this very closely. But I think of this attitude, the attitude of China, being open a little bit more, I think that's going to be a step in the right direction, and realizing that they need to play by global free trade agreements and rules if they're going to be successful. So I'm positive about things going forward with China.
And what's your comment regarding this injection of liquidity once again of the People's Bank of China? I mean, of course, this is something that is the Federal Reserve is also doing, but what is your comment on this last movement of the central bank?
Well, I think it's a logical move. They do need to get some liquidity in their economy. So I think it's a right step. If we think about what are the choices that central banks have, they can lower interest rates, they can buy and sell securities, and they can also change reserve requirements. China leans towards changing reserve requirements, I think, more than other central banks. So here in the United States, they typically do not change reserve requirements. They'll change the interest rate. And they will buy and sell securities. There's 22 dealers that work with the U.S. Federal Reserve. And those dealers are how the Federal Reserve can put money in and take money out of our money supply. China has a tendency to use these reserve requirements. And what's interesting about it is that it's an immediate impact on liquidity. because once you lower it, now banks are freed up to loan that money out. So it doesn't take a long process to inject that liquidity. So I think China's doing the right thing in that regard. I think it's also a reflection of what's happening within the country in terms of their economy, but I do think it's a step in the right direction.
Well, that's very interesting. I want to have also a very quick look at the Forex exchange. So far, the dollar index actually is trading higher this evening, snapping this 6 days losing streak that we saw in the last few days. So far, 96.84 higher by 0.4%, euro dollar 1.11, and the sterling against the dollar 1.31. As we can see, it's lower by almost 1% this evening. What is your comment on this? How can I say sudden increasing of the dollar index?
Well, I think it's, to me, it is, I've been expecting it for a while, but it hasn't happened. I think right now it makes sense. If we think about what you started with the U.S. stock indexes, and you were mentioning the strength that we've seen in that. Well, that creates interest from other countries. And that interest from other countries, if they want to participate in the U.S. stock market, need to change their currency to the US dollar. And I think what we're seeing today is a reflection of that. Here's the issue that you and I want to watch, though. Is it sustainable? So it's not only so much what we do this week with the US dollar, it's what we do next week. Do we get follow through? Does that strength and momentum that we're seeing building for the US dollar, can it follow through? So I do look for a stronger close tomorrow. But next week it's going to be very important in terms of maintaining momentum for the US dollar.
I want to move to the energy sector because certainly it's a sector to watch, especially in 2020. Very quick look actually at the oil price. So far, the U.S. oil is trading $60 per barrel and Brent is $66 per barrel. Actually, very steady beginning of 2020 for the oil prices and the energy market. I shall point out that the energy sector was one of the worst performers for 2019. Actually, it was the last one, I believe, among the 11 S&P 500 sectors. Many traders, I shall point out, are very bullish for the oil price in 2020, and actually they're betting on energy stocks. What is your opinion? I know your opinion. You're not bullish on the sector, that's for sure. But have you changed your idea?
No, I haven't. And the reason I haven't, the reason I haven't is goes back to global supply. I just don't see an issue with that at this moment. So the idea of sustaining higher prices, I have a hard time imagining that. Now, when it comes to individual stocks that we can look at, I have some energy stocks in my portfolio. So, and am I going to hold on to them? Yes, I am. But, you know, some companies are highly diversified when it comes to their exposure to crude oil. So does it have an impact? Yes. Do I look for higher prices in the crude oil sector? I'm very skeptical. I mean, if we think about OPEC, if we think about our friends there, they'd like to see, you know, crude oil $70 or $80 a barrel. It allows them to balance their budgets, and it's a positive thing for them. But do we have a reason to get there? Now, if we have a super weak US dollar, then I can see some upward movement for crude oil. But right now, I am very skeptical of strong prices this year in that marketplace.
And when you mentioned that you have some stocks, like energy stocks in your portfolio, do you also have a look at European stocks, like let's say British Petroleum or Shell, or you are only focused on US stocks and US companies?
I do look at those stocks. From an investment point of view, I'm only investing in them indirectly through the indexes and other things that I invest in. So to invest for me personally directly into those stocks, I do not do, but I do look at them because they're all part of that same energy community that we want to be aware of. And those are major players that you just mentioned. So we want to see how they're absorbing information as well, too.
And what about Saudi Aramco? If I mean, it's listed only in its domestic market, Tata Wool market, but if it was an international listed company, would you consider it?
I'm not sure about that one. I know there's a lot of hype that it's such a large company. The expectation is such a major player that indeed we'll see higher levels in the future. I'm not super bullish on that at this moment. Would it be a good stock to have in a portfolio if we could do that, or if we had an account on that exchange? Possibly. I don't expect a huge downside move in that company. So I think we have some stability. It's not a new adventure. So if we think about Aramco, it's a proven company. It operates, it's functional, it's efficient. It pays $2 and I think 80 cents to get a barrel of crude oil out of the ground. It's the lowest cost producer of crude oil in the world. And it's proven. It's been around for a while. So there are some positive things for it as an investor in that company. But in terms of long-term growth, I could see it moving higher. Do I see a strong move this year, unless it's more of an international player in terms of the stock market? No, I don't. I think it had growth, but I'm not looking for spectacular growth this year in that company.
All right. Thank you very much, Daniel Gramza, President, Gramza Capital Management. Thank you so much for joining us, and once again, Happy New Year.
Thank you. Happy New Year to you too. It's always a pleasure to be with you.
Always pleasure, Dan. Talk to you very soon. Well, we're heading for a very short commercial break, but stick around, guys, because in the next part of the show, we're going to talk about are recession fears fading away or not, because there are very different opinions on the topic. Stick around. Welcome back to Lefoni International. Wall Street kicked off 2020 with a great results. I shall say S&P 500 is 3,239 points. Dow on the other side also hitting fresh new record highs at 28,707 points, and Nasdaq Composite 9,037, more than 0.7% higher so far. On the other side, the VIX index slightly lower at the 12th level, and of course, once again, the technological shares and industrials are leading the gains this Thursday evening. So far, if we have a look just at the FANGs, Facebook is higher by 1.5%, Amazon as well 1.56%, Apple 1.54%, Netflix, Google as well, and Microsoft 1.17%. And I want to point out once again that Apple and Microsoft were the two best performing technological shares stocks for 2019. We're certainly going to discuss all of them. And I want to show you also the SOX index, a great performance this evening, 1.44, almost 1.5% higher, with all the major stocks trading in the green territory except Qualcomm, which is slightly lower, 0.11 below the flat line so far. Uber and Lyft, are also trading higher. Both of them, Lyft is 1.40 higher, and this is a beautiful rally, a beautiful beginning of 2020 for Uber, 2.42% higher. Pinterest also 1.40 higher, and of course Slack Technologies 1.02% higher. So a little bit of positivity for those tech unicorns. I want to show you very quickly also the bond market. So far, the US 10-year is yielding 1.88, the 2-year 1.58, and the 3-month 1.54. As you can see, slightly lower treasury yields in 2020. On the other side, the US oil is trading $60 per barrel, and the Brent $66 per barrel. In terms of Forex, the dollar index snapped this 6 days losing streak, 96.81 so far, 0.4% higher. Euro dollar 1.11, and sterling against the dollar 1.31. After this, I want to show you very quickly some economic data regarding the United States. Of course, here's jobless claims. Actually, the number of Americans filing claims for jobless benefits edged lower last week, a positive signal for the U.S. labor market amid recent signs that new claims may be trending slightly higher. Initial claims for state unemployment benefits decreased 2,000 to a seasonally adjusted 222,000 for the week ended December 28. The Labor Department said on Thursday economists polled by Reuters had expected 225 new claims last week. So a little bit of positivity also in terms of a macroeconomic point of view. And of course, I want to bring you some stats so far. I want to remind everyone that S&P 500 closed 2019 28.8% higher, Dow on the other side 22.3% higher, and Nasdaq up 35%, together with SOX 600, which finished the year up 23%, and Shanghai Composite climbed 22%. So as we can see, pretty positive 2019 for the US indices. Of course, also European stocks, and not to mention the bond market. That was a blockbuster year for the bond market. In order to go ahead, let me bring to the show my next guest this evening, Matthew Malley, Managing Director at Miller Tabak. Good evening, Matt, and thank you so much for joining us.
Thanks for having me, Alex, and Happy New Year.
Happy New Year, Matt. So far, great beginning of 2020. What's your comment?
Well, it's being driven this morning by the news overnight that I say not this morning, we're now in the afternoon here, and I know it's in the evening there, but the previous evening we got news out of the PBOC, the Chinese central bank. They're going to be adding more liquidity to the system for certain rules with their banks, and that's certainly very positive. And of course, we've seen the central bank liquidity pick up all over the world, but especially in the U.S., where this the new QE program that's had to deal with this problems they've had in the repo market, and even though the Fed keeps saying that it's not really the kind of traditional QE they've done in the past, it's still adding liquidity to the marketplace, and that's helping the market rally. And we are seeing a pull back a little bit off the highs, which is no surprise that it's had this great run recently, but it still acts very well today.
Absolutely. Matt, I was just saying that S&P 500 closed 28.8% higher, which is almost 30% in 2019. On the other side, Dow 22.3%. Can you explain us the difference of the importance for these percentage points for the two indices?
Well, it's just because I'm afraid a few small stocks, I'm sorry, a few rather large stocks, but a small number of names that are in the Dow index lag the market a little bit. And then, of course, one of them was the obvious one is Boeing, which have had all their problems over the last almost 6 months now, or even longer, really, since the spring. And so it's been a small number of names that have kept kept a little bit of a lid on the Dow Jones Industrial Average. But overall, it's still been a good, obviously a good rally in the market. We've also had a lag in some of the small cap names, but that's been playing catch up in a big way more recently. So, to be honest with you, I'm a little concerned. I mean, you mentioned we're up 38. We're up almost 28%, almost 30% last year. But if you take it from December 24th, in other words, day before Christmas in late 2018, so basically, there's 52 weeks in a year. If you counted 53 weeks, we're up almost 38% in a year. So it's been quite a run, and at some point soon, I think we'll get a little bit of a pullback. That will be normal and healthy, and people should be prepared for that in advance in case we do get one in the next month or so.
And on the other side, are you surprised by the Stoxx 600 22% gain for 2019? And if you had to compare Stoxx 600 to S&P 500, because it's our, how can I say, a benchmark comparison here in Europe, what's your take?
Well, like anything else, it's been, it's just like I mentioned with the Russell, but even more so, the European stock market has played catch up in a major way, and it's outperformed at least since August. And so that's a very positive sign. And there's no question that you would think if we are seeing kind of a bottom in global growth, and we're going to see earnings turn around, the stocks that have underperformed the most and the markets that have underperformed the most are the ones that should do the best. And I think you'll see that also with emerging markets, which again have outperformed in recent months. So I think it's a thing where there's no question that the U.S. Economy is doing better than the European economy, by a decent amount. But the thing is, whenever you're buying stocks, you get the ones where the stocks or the groups or the areas of the world that have been kind of thrown out with the baby with the bathwater, and that was kind of what was done in the first half of last year in Europe. So I think it's giving us some pretty good opportunities because they are finally starting to play catch up.
On the other side, since, of course, many invested in equities and were more open to risky assets because of the recession fears which were fading away, I saw a very interesting article of the Wall Street Journal that actually says that fear of an economic decline topped the list of their concerns of several Wall Street CEOs. So in your personal opinion, if you have a look at the bond market, which is yielding treasury yields or index slightly lower this evening, what is signaling the bond market up? Do you think recession fears are fading away or not? Because I've heard so far very different opinions regarding the topic.
Yeah, it's very interesting that you mentioned that. I was really surprised to hear that same story, that it's for CEOs in the U.S. anyway. One of their biggest fears is a recession this year, which I think for a lot of market pundits and Wall Street people, Wall Street strategists and economists, that's something that they're not looking for at all. In fact, if anything, as you mentioned, those kind of fears have kind of washed away. However, one of the things that, one of the reasons that concerns me that may be accurate is that, interest rates have bounced off, their August lows. They were down in the U.S. They're down near 1.4%. Now it's up near 1.9%. Even though that's still very low, it's quite a jump. And one of the reasons behind it, you say, well, that's okay because the economy is starting to pick up and the global growth is bottomed. And so if interest rates go up, that's fine. But if we are still having a sluggish economy, you can still have interest rates go up, because one of the things we're seeing is that with Christine Lagarde taking over at in charge of the ECB, she is very much against, or seems to be very much against, negative interest rates. And of course, we see where the German Bund and other European rates have moved up, and some of you have actually gone into positive territory. And of course, the German Bund is getting close. So as interest rates go up around the world, they're also going up in the U.S. because part of the reason that their rates were so low was because of that competition from overseas, and therefore, so if interest rates move up, but it has to do with that move away from negative interest rates rather than a real increase in economic growth, it will cause a headwind for the market. So it's definitely something to be concerned about if we see rates start to move above 2% in the U.S.
And talking about Europe, you've just touched a very interesting topic. I don't know if you've noticed today that today actually the banking sector literally kick-started 2020. Deutsche Bank and Commerzbank in particular closed higher by, I believe, more than 6%. UniCredit also almost 3%. Are you bullish on the European banking sector, and how do you explain this? How can I say kick-start of 2020?
Well, I mean, the reason I think more than anything else, again, is this thing I just referred to about with Christine Lagarde, because these negative interest rates were absolutely killing the European banks for a year or more, and now that it looks like they're going to be moving that in the other direction. That's bullish for banks. We're also seeing a steepening of the yield curve. Again, these are all bullish for not just U.S. banks, but as you mentioned, European banks. There are certainly some concerns there, and it's something that I had voiced in the first half of last year with the European banks, having some problems. But there's no question that a move away from negative interest rates is positive for the group. So again, it's one that was a group that was thrown out with the bathwater, the baby with the bathwater, when the European markets were going down the first part of the year, or at least underperforming badly in the first part of the year, and so it gives it more upside. The one thing I just say though is interest rates move up. That's positive for the banks, but after a while, it can act as a headwind for the economy, and after such a huge rally we've seen, at least in the U.S. in the last year, it's going to be hard for us to see the same kind of rise. So that's again why I'm looking at stocks and asset classes outside of the U.S. that have not had as big a run as the U.S. market has seen.
And Matt, would you take a look at the European stocks, in particular the banking sector? Because I wanted to point out for our viewers that 2019, as I guess they very well know, was a very, very difficult year, in particular for the banking sector, exactly because of these negative interest rates. All of them, the major CEOs were complaining. We also heard several U.S. CEOs who said that they completely disagree with these negative interest rates, and they are definitely damaging the sector. So, I mean, considering the kickstart of the year of the banking sector here in Europe, would you take a look at them throughout 2020, or they're not in your, how can I say, picks? They're not your picks?
Well, they're not really at the top of my picks because there is definitely some risk involved, but and some more risk than there are in other areas of the European stock market. So I guess my point would be that where you get the highest risk, you get the most reward. So there's nothing wrong with taking a small part of your portfolio and the money you have spread it around and put it into some of these names, especially if you're somebody who's more risk averse, that you're more willing to take risk. We've known that whenever you're taking, it's hard to catch a falling knife. So to actually catch the absolute bottom of a big sell-off like we saw in the European banks is very, very difficult. But that bottom has come, at least for the near term. So you have a little bit more room. But I guess my point would be there's nothing wrong with putting some in there, but you don't want to put your whole portfolio in there because there are still some significant risks because interest rates do stay low and they still have some issues that they're dealing with.
Well, that's certainly very interesting. I want to talk about the energy sector, our favorite energy sector, and I want to hear your take. Why? Because I've heard so far very different opinions. I shall point out, though, that the energy sector was the worst performer among the 11 S&P 500 sectors. 2019 has been actually was a very, very difficult year for the oil market, the energy sector, the energy stocks and everything. But many traders and senior analysts are saying, all right, 2020 is going to be a better year. We're bullish on the sector. We would rather take a look at some of the stocks. What is your opinion?
Well, I must admit that I felt a little bit more comfortable with my bullish stance, a couple of months ago, because I was one of the few people who was bullish, and the group has had a nice move since then. But I'm still like the group, and there's a couple of things. Number one, if the market does get, if the broad market sees any kind of a correction for whatever reason, I mean, I'm talking about a deep correction. What groups are going to get hit the hardest? The ones that are most over-owned, the ones that have done the best. I mean, we saw that certainly in the big correction in the fourth quarter of 2018. FANG stocks got absolutely clobbered, and that's because people were loaded to the gills with them. Well, the energy stocks are very, very under-owned. And there's definitely some, especially on the smaller side, who have a lot of debt. And if we go into a recession, they're going to have some problems. But if you get some of the quality names who've increased their dividends a year in and year out for many years, and there's several of those in the energy sector, your downside is going to be relatively limited. And the upside, again, going back, but so that's if we have a negative thing. If the market continues to move higher, especially if oil prices can hold up, here's a group that people are going to play catch up in. The institutional owners will have no choice but to jump into the group, whether they like it or not, because they're so underweighted in the group. So I think the risk reward still favors the group in a big way. But again, you want to be a little bit picky and maybe a little bit more conservative because this group is so underowned. Being with the conservative name still gives you more upside than it would normally give you in some of the big cap names of other groups. So I'm bullish on the group.
And I wanted to ask you, what's the price range, in your opinion, for the oil price, in particular WTI so far, $60, I shall say, steady start of 2020 for the oil price. But what's the price range that you imagine, at least for the first quarter?
Oh, well, for the first quarter, I mean, you can always get some wild swings, but I just think the downside is in the mid 50s, where the upside is probably in the mid to high 60s. Does it get to 70? Of course it could. Could it drop all the way to 50 or below? I mean, but something new would have to happen for that to take place, and I just don't see anything on the horizon that's going to create that kind of a move. But I guess the most important thing is that I do think it kind of holds steady here, and that is enough for the oil stocks, the energy stocks, to rally nicely. Because not only has the energy sector lagged, as you talked about, but it's lagged the broad stock market, but it's also lagged the underlying commodity. It's well behind the price of either West Texas Intermediate or North Sea Brent. So if those prices can hold steady, they still have upside potential. So my point is, you don't need a move into the mid to high 60s in crude oil for the energy stocks to rally further.
Well, that's extremely interesting. I wanna know, what is your opinion on the healthcare sector, because there is also a very interesting article on the Wall Street Journal that says that drug prices climbed by 5.8% on average, less than last year. And of course, the healthcare stocks are going to be very observed in 2020 because of the presidential elections, because each and every one of them has completely different ideas regarding the sector. So do you expect a decline for the stocks, or it depends on who's going to be the next president of the United States?
Well, that will certainly make a big difference. And one of the things that I worry about, it's funny, when I turned more bullish on the sector during the year this year, or last year in 2019, one of the reasons, it was really more technical in nature than anything else. But we saw some breakouts in some of the key ETFs like the XLV and the IBB, biotech ETF, and also some individual names like United Healthcare, et cetera. But it was more technical in nature. And that doesn't mean that it can't last longer. But the one thing I worry about is, again, as you mentioned, it's a political year. It's an election year. And especially as we move towards the conventions, the political conventions, they don't take place until the summer. But if President Trump, if things tighten up, and they always seem to, no matter what the eventual thing, even when there's the election ends up being a landslide, at some point during the election year, it tightens up. And you could see that over the summer. And if that happens, then you see the president start to say, hey, I need, a good bipartisan issue is healthcare prices, drug prices. And then they're starting to see a kind of a war between the two of them. Who could put the most pressure on the drug companies to lower their drug prices? That could certainly cause a sell-off in the group. So there's a lot of reasons to think it's good, but if the Democrats, whoever the Democratic nominee starts to take, especially if it's somebody like Bernie Sanders, who's reported today that he led the whole Democratic side in fundraising in December, that's going to be a problem for the group. So I think you want to start to lighten up on it a little bit as we move through the first half of the year.
I want to bring to the show a very interesting story, actually one of the major story nowadays, and it's regarding, of course, Carlos Ghosn, who fled to Lebanon. Actually, Lebanon received an Interpol arrest warrant for fugitive former Nissan boss Carlos Ghosn, while Turkey launched an investigation into his daring escape from Japan. Of course, situation there is getting really hot because, of course, Ghosn has become an international fugitive after he revealed on Tuesday he had fled to Lebanon to escape what he called a rigged justice system in Japan. Only a few hours ago, he confirmed that this plan of flee plan was only and exclusively done by himself, and his family was not involved. So there are many interesting things over there. I just wanted to point out that Lebanese government officials could not immediately be reached to say what, if any, action would be taken. And in past cases where Lebanon has received red notices for Lebanese citizens resident in the country, the suspects have not been detained, but their passports have been confiscated and bail has been set. This is a judicial source, according to judicial sources. Matt, I just wanted to know your general opinion on this story, and I mean, is this how can I say, unprecedented?
Well, yeah, it sure is. I mean, it's funny. I heard one person say today that they're going to do the next James Bond movie. It's going to be about the escape that he pulled off. But the thing is, the one thing on both sides, it's very interesting because one of the things that's really showing it and highlighting once again is the Japanese judicial system. The quote I heard today, I was not familiar with this, so I must admit I wasn't familiar, but from other reports saying that the conviction rate in Japan is something like 99%. So whether he's guilty or not, it is very, very, very difficult for somebody to prove his innocence, his or her innocence, when you're put in the solitary confinement. You don't get the representation you'd like. You would certainly get in the United States or in Europe. That's on the one hand. On the other hand, though, you also look at this like, is somebody in Japan ever going to get bail again? Because they usually don't give bail to people. Now that this famous person got bail and escaped, Japan's going to even lock down even more. So the whole thing is really extraordinary, and it's going to play out in the newspapers, and I'm sure they'll be making a movie about it at some point, whether it's James Bond or not. But I guess my point is it shouldn't have any impact on the markets. But it's a very, very interesting story, and but I think in the long term, the real impact is going to be how people look at Japan. And I wonder if it's going to have the kind of, if there was going to be an impact on any market, it might be Japan, but that would be over the long term because, some companies might start worrying about having their executives involved in that country.
You know what's interesting, that after this story with Carlos Ghosn, both Nissan and Renault performed very badly in 2019. It's been a horrible year for the stocks, and also in terms of production, in terms of fundamentals and also technical analysis, not really good year. But what do you think, what do you expect? Do you expect a deterioration for this alliance, Nissan-Renault alliance? Because, I mean, Carlos Ghosn has been an extremely important figure. I mean, how can I say, for this alliance, he was at the helm for many, many years.
And yes, and he certainly had had a great reputation for his his business sense. The one thing, of course, you worry is that, as you mentioned, these stocks come down, and one of the things that you hear people talk about is that he was such a dominant player, or a person in his company, that he was constantly forcing or pressuring the people underneath him to meet their goals, meet their quotas or whatever, and therefore they did some things they maybe wouldn't have otherwise done that weren't necessarily good business sense, just to make him happy. And so now we're starting to see that well, geez, now that they get to open up the books and see a little bit better that maybe the companies weren't doing quite as well as he portrayed. And so you get a little bit of a worry there. And we're in such a tumultuous time for the auto industry around the globe with, obviously Tesla and automated driving and all these things. So it's just a group that I understand Ford Motor was downgraded to a sell by one of the bigger firms on Wall Street today. So it's just a group where so many things, there's just so many other areas in the marketplace that have more potential in my mind. And I just don't think that the auto industry is one where I want to be a big player. If you want to take a flyer, again, take some risk on a Tesla or something like that, that's fine. But when you really want to look for long-term investments, there's some other areas that I think are going to be much better.
All right. Thank you very much, Matthew Malley, Managing Director at Miller Tabak. Thank you very much. And once again, Happy New Year.
Thank you. You too.
Well, that was the last story for this evening. Thanks so much for watching, guys. And see you tomorrow exactly at 6:45 p.m. on Le Fonte TV. Che cosa?